All right, let's dive right in. Today, we're looking at a huge economic signal that just went off, and some say it has a flawless track record. This could be it, the final warning before a major market crash. So this is the core idea from our source material. It's a bold statement, right? It pretty much says we're on the edge of a cliff. But what on earth does uninverted even mean? And how could it possibly predict a crash? To really get what this warning is all about, we have to understand the tool itself. So let's break down exactly what this mysterious yield curve actually is. Don't worry, I promise we'll make this crystal clear. Okay, think of the yield curve as a simple snapshot of the market's confidence. It's just a graph that plots out the interest rates, the yields, on government bonds over different periods of time, from the short term to the very long term. Basically, it's a picture of how much it costs the government to borrow money. Usually, it's simple. You get paid more interest for locking your money away for a longer time. That makes a nice, normal, upward-sloping curve. But every so often, the whole thing flips upside down. Short-term rates suddenly become higher than long-term rates. That's what we call an inversion. And yeah, it's a pretty well-known sign that the economy is getting nervous. But here's the twist. The inversion itself isn't the final alarm bell. And this, right here, is the crucial point. According to our source, most people are focused on the inversion, but they're looking at the wrong part of the cycle. The real signal, the final warning, that's something else entirely. Okay, now check this out, because this slide really puts it all into perspective. On the left, you've got the common belief. The inversion is the big, scary signal. But on the right, you see what the source calls the historical reality. The crash actually happens after the curve starts to fix itself, after the uninversion. So how does this work? Well, it's kind of like a chain reaction. First, the curve inverts because investors are getting worried about the future. Then the central bank, the Fed, sees this, panics, and starts slashing short-term interest rates to try and juice the economy. These rate cuts push short-term yields back down, which causes the curve to uninvert and look normal again. But according to this theory, it's just too late. The damage is already done, and the crash is next. It's a compelling theory, for sure. But does it actually hold up? Let's look at the historical evidence and see how this pattern has played out before. This is where the argument really gets its teeth. A perfect record. I mean, just let that sink in. That is a massive claim. The source isn't just saying this is an indicator, they're arguing it's the definitive one, the one signal that has shown up without fail right before the biggest financial crises of our time. And this just illustrates the pattern perfectly. You can see it right here. Before the Great Depression in 29, before the dot-com bubble burst in 2000, and before the global financial crisis in 2008. Every single time, the yield curve inverted, and then it uninverted. That uninversion was the final step right before everything went south. So if history really is our guide here, what does this signal mean for us? Right here, right now. Let's connect this ominous pattern to today. You know, historically, there's always been a bit of a delay. After the uninversion signal triggers, the market crash doesn't happen the very next day. The data shows there's this lag time, anywhere from 6 to 24 months. That's the window where the final stage of the economic cycle seems to play out. And here's the punchline. The yield curve has, in fact, recently uninverted. So if we follow that historical timeline, the source argues that this countdown has already been running. And that 6 to 24-month window, it's now closing. The grace period, they say, is over. So what's the takeaway from all this? The source material gives some very direct advice for a scenario like this. Move to safety, hold cash, and get ready for a big opportunity. The idea is to be prepared to buy assets at a huge discount when the market finally hits bottom, to, buy the dip. Which leaves us all with this one final provocative question. A black swan is supposed to be this unpredictable, rare event that has massive consequences. But if you believe this signal and its track record, what some might call a black swan, well, it might not be so unpredictable after all. Is this the moment it finally arrives? That's the big question we're left with.